Thank you, David. And thank you to the Economic Club of Washington for inviting me to speak to you today. The U.S. economy has recovered substantially since the Great Recession. The unemployment rate, which peaked at 10% in October 2009, declined to 5% in October of this year. At that level, the unemployment rate is near the median of FOMC. I anticipate continued economic growth at a moderate pace that will be sufficient to generate additional increases in employment, further reductions in the remaining margins of labor market slack, and a rise in inflation to our 2% objective. I expect that the fundamental factors supporting domestic spending that I enumerated will continue to do so, while the drag from some of the factors that have been weighing on economic growth should begin to lessen next year to best foster the attainment of those objectives. There has been considerable focus on the first increase in the federal funds rate after nearly 7 years in which that rate has been at its effective lower bound. We've tried to be as clear as possible about the considerations that will affect that decision. Of course, even after the initial increase in the federal funds rate, monetary policy will remain accommodative. And it bears emphasizing that what matters for the economic outlook are the public's expectations concerning the path of the federal funds rate over time. It is those expectations that affect financial conditions and thereby influence spending and investment decisions about the economy and monetary policy. The economy has come a long way toward the FOMC's objectives of maximum employment and price stability. When the committee begins to normalize the stance of policy, doing so will be a testament also to how far our economy has come in recovering from the effects of the financial crisis and the Great Recession. And in that sense, it is a day that I expect we are all looking forward to.
When quantitative easing was begun, did you expect it would be in effect for such a long period of time?